All right, well, good morning, everyone. Thank you for joining us today for this presentation on cottage succession. I have with me Maureen Glenn, who is a certified financial planner and the manager of our tax and estate planning group here at Richardson GMP. This presentation shouldn't take more than 20 minutes. As the weather starts to get cooler and cooler day by day and cottage owners start to think about closing their cottages, our group felt that it was a good time to discuss cottage succession strategies. In this presentation, Maureen's going to be discussing from a high level key issues facing cottage owners today, issues such as taxes and fees, different ownership strategies, and she'll also address some of the tools cottage owners can use to minimize delay or even transfer the tax liabilities. As mentioned, because of the complexities of the issues and different strategies, this presentation will be very high level. As each situation is different, we'd be more than happy to discuss your own situation on a one-on-one. I'd now like to turn it over to Maureen Glenn. Hello, Maureen.
Hi, Frank. Thanks very much for inviting me to join you today. As Frank mentioned, I'm the manager of our tax and estate planning team here at Richardson GMP. And we're a team of accountants, lawyers, estate planners, and certified financial planners across the country, serving Richardson GMP's best clients to help to provide some solutions and advice on some of the more complex tax planning strategies and estate planning issues that you may be facing. We work as an extension of the Ortencio team, and very happy to join you today to talk about cottage succession planning. So, just to get started, the cottage is one of the most, those assets that has the most emotional attachment for many of us. Many families have had a small cottage that perhaps the grandparent purchased back in the 1940s or 50s for next to nothing, that has now grown into a family heirloom. A large house, perhaps a cabin, a dock, those places where cousins share bunk beds and roasted marshmallows over the fire. So there's a lot of emotional attachment to this asset. And many families wish to be able to preserve that when we look into the future. Whether your cottage is fairly new in your family or whether it's been in the family for many generations, we often think in the future and think, wouldn't it be wonderful if our future grandchildren could benefit from this beautiful place, this very beautiful piece of heaven. But there's some issues around transferring that down the generations. From an estate planning standpoint, we need to look at three key issues. One is reducing taxes, and today I'd like to talk a little bit about what those taxes might be. And when those taxes may occur, ensuring that it's an effective transfer. So you don't want to pass an asset with this much value onto the next generation and do it poorly, because unfortunately that can have implications for the next generation and beyond. And of course, we want to preserve family history, family harmony. Family harmony can, as the family gets larger and there are more siblings and there are more grandchildren and spouses, things can emotionally get a little bit supercharged. So we've got some suggestions for you around that. So very briefly, I want to talk a little bit about the taxes and fees that apply and why that's an issue with passing the cottage on to the next generation. As solutions, there are a few things. We can talk about ownership strategies, using trusts perhaps as a structure that might assist, and life insurance solutions as well. And finally, we'll talk about some of the softer issues around reducing family conflict and what you can do to plan in advance. So let's talk about the boring stuff. The technical issues around taxes and fees on transferring a specific asset onto the next generation. In this case, it's a cottage that may have accrued in value significantly over time. So where I've seen cottages up, for instance, north of Toronto in the Muskoka area, that may have been purchased for only a couple $100,000 years ago, they've now increased in value to perhaps over $1 million. If you've looked at any of the listings in some of the, the hottest spots in north of Toronto, you know that those cottages are absolutely beautiful properties and worth a significant amount of fair market value today. Capital gains tax is a tax in Canada that applies when you've disposed of an asset, and that occurs when either you gift or give the property to someone or sell the property. It also occurs on death. So if you own an asset, on your death, capital gains tax will apply. Capital gains tax is calculated as the fair market value less the adjusted cost base and 50% of that amount is taxed in your hand. So that's the technical piece.
So eventually, sorry, Maureen, I'm just going to interject here. So capital gains, basically, the individual who owns the cottage will pay capital gains one way or another.
That's right. It really comes down, Frank, to a matter of timing. So if you were to sell the asset today when it's worth, let's say, $500,000, and your cost base is $100,000, you'd have a capital gain of $400,000. If you waited 10, 15, 20 years down the road and the property is now worth $700,000, well, your capital gain has now increased by an additional $200,000 to $600,000 of capital gains. That capital gain is going to get paid one way or the other, but there are some strategies that we can use to minimize it. One of those strategies is the principal residence exemption, and many of you may have heard of this, and there's a lot of misconceptions around it. It's changed over time as well, which creates a lot of confusion for people. I'm not going to get into the details today, but ultimately the bottom line is each family in Canada is allowed to claim an exemption on any capital gains on their principal residence. Now, when we think of a principal residence, we often think about the house that we live in, perhaps in Toronto. Alternatively, we could use other assets. So if you own more than one real estate property, there may be a way to use that principal residence exemption on the cottage instead of the home in Toronto. Now, there's some rules around it, and you need to make sure that you do it properly. You don't have to make the decision about which property is going to be your principal residence until such time as you actually sell or dispose of the asset. So either you give it to someone, you sell the property on the market, or you die. And that's when that calculation is going to occur. And that's when you can make the choice of whether that principal residence exemption, your tax advisor will advise you on that. Some of the misconceptions are that you have to have a vehicle registered at that property with that address in order for it to be your principal residence, or that you have to live there for 6 months of the year in order for it to be your principal residence. Neither of those is true. As a matter of fact, really a cottage would qualify as your principal residence even if you only use it for a week or two every year. There's a rule called ordinarily inhabited, which generally means you're using it as a home at some point during the year for your family.
This is this strategy. There's actually an article or part of an article from your group that's available for any listeners out there that want to read a little bit more in detail about this strategy. Is that correct?
That's correct. Actually, we've got articles on several of these topics that we're happy to share with any of your clients, Frank. And the articles go into a lot more detail on the actual strategies around this and some of the rules you need to follow and some of the cautions that we'll provide. However, what I would suggest is if you have more questions, everyone's situation is very distinct, so it's hard to say that this rule is always, well, the rules are always true, but how does it apply to your particular situation? So Frank, I'd encourage you to talk to your clients about their specific situation and draw our group in if they need some additional advice.
Excellent. Thank you.
The last thing I'll talk about with taxes and fees before we get really bored about taxes and the technical stuff is probate fees. In Ontario, we have something called the estate administration tax, or commonly referred to as a probate fee. And in Ontario, that fee is 1.5% of the gross value of your estate on your death. Certain assets are excluded from that calculation, and because 1.5% may not seem like a large fee, but of course we always want to minimize taxes whenever we can. So with some proper planning in advance, we can arrange to either avoid the probate fee related to the asset, in this case your cottage, by possibly transferring ownership of that cottage in advance, like prior to your death. Alternatively, we can quantify that and decide whether there's other planning that needs to be done in order to adjust for that probate fee. So let's talk about ownership strategies, because these are some of the solutions that you often hear about. We hear about assets being transferred into joint ownership a lot of times. And when you transfer an asset into joint ownership, if the person receiving ownership hasn't paid you anything, then really you're giving a gift. A gift will still trigger a capital gains tax, but it depends on who you're giving the gift to. So there's some significant tax rules around transferring assets between, for instance, adult members of the family and children within the family, or other adult family members on a non-arm's length basis. Timing considerations include, when do you transfer ownership? Are you going to transfer that ownership today and deal with the capital gains we mentioned the example of a $400,000 capital gain. Only 50% of that capital gain is taxed in your hands, but do you want to freeze that capital gain today, transfer ownership of the cottage to your adult children, and then move forward from there? All the future growth on that asset then would be taxed on the new owners of the cottage being your children. But timing is an issue. You need to think about your retirement income needs as well. So if you're already retired, you're looking at all of the assets that you currently hold, and the cottage is worth $500,000. If something were to happen, if your health were to deteriorate or you had a significant emergency expense, you always know you could sell that cottage or mortgage the cottage to get the funds you need. Maybe not the first choice, but it is an asset that you own, that you have access to funds. So before you transfer ownership of anything, you need to make sure that you have sufficient other assets to provide income for you for the rest of your lifetime.
Is another consideration also because you're transferring it, let's say, to your children, adult children, then you're technically prepaying that capital gains.
That's right. So you're really freezing the capital gain today for the growth up to today, and the future gain would be taxed in their hands.
So you would need some money or cash flow to pay for that liability, correct?
Exactly.
Okay.
And there are some tax strategies that we can use in order to spread that tax liability out. You may be able to use the capital gains reserve without going into detail. That might spread out the tax liability over a 5-year period. You need to be careful of what value you transfer the asset to the new owners, so that they're not adversely taxed in the future. So these are some of the issues we need to be aware of. And one of the things that you need to be very cautious of is the fact that when you transfer ownership of anything, you lose control of that asset. So there are different ways that you can get around that. You could potentially take back a loan for the value of the asset or a promissory note. We could also use structures such as trust, and we're going to talk about that very briefly in a minute. So there's a different ways that you can own an asset very briefly. You can own an asset like a real estate property, like a cottage, joint tenants with rights of survivorship, or tenants in common. And these are two important concepts to ensure that when you do transfer an asset or decide to share ownership of an asset, that you do it in the most tax-effective way. If you transfer it to joint tenants with rights of survivorship, on your death, the new owner automatically becomes the owner of that asset. It doesn't go through your will. It doesn't get probated, so there's no additional probate fees.
So you're saving on probate.
You could potentially save on probate. However, there are some other eventualities we need to be cautious of and some potential consequences. Alternatively, if you own the asset tenants in common, then if you owned 50% of the asset and you died, that asset would pass through your will, or 50% of the value of that asset, and will get passed on to your heirs that way. So very often we see cottages that are owned between two brothers, for example, that are owned tenants in common instead of joint tenants. Concepts that we are fairly complex, but we can certainly talk more about that when we know a specific situation. So let's talk about trust a little bit. Some of you may have heard of trust. A trust can be either set up during your lifetime, which is called an inter vivos trust, or on your death, which is a testamentary trust. Ultimately, by transferring the asset into a trust, you're doing that capital gains tax free. So you're dealing with the tax today and getting it over with based on the value today. Once the asset moves into the trust, there are some additional benefits. The asset now has creditor protection if the trust is written properly. So let's use the example of Grandma and Grandpa own the cottage. It's worth $500,000 today, and they transfer that asset into the trust. Should the beneficiaries of that trust, let's say their adult children and their grandchildren, have any creditor issues, perhaps they've declared bankruptcy or they have significant liabilities and their creditors are chasing, if that asset is held properly within the trust, that your child's creditors will not be able to access that asset or declare any kind of claim against it.
This is one benefit of making sure that the cottage stays within the family, depending on
Exactly.
whatever. It doesn't matter what happens.
So it's a way of protecting the asset from the claims of anyone from outside. Similarly, if it's drafted properly as the discretionary trust, then you may have some protection against marital breakdown in the future. And while none of us like to think about this, we all know it's a possibility. And one of your grandchildren may get married, may divorce later on, and you certainly wouldn't want the ex-spouse of your grandchild to have any kind of claim on an asset that has been in the family for many generations, perhaps. So a trust may provide that level of protection. A couple of things to think about if you're considering this structure would be ensuring that you have some way of maintaining control over the asset. So if the grandparents remain as the trustees of the trust, they can ensure that the cottage is still maintained properly, looked after the way they would like it to be. They can also control who gets access to the cottage on which weekends, who gets the best long weekend in the summer. If there's any sibling rivalry out there, many of you may have experienced that with a cottage.
That's benefiting keeping harmony in the family.
Exactly, and we're going to get to that next. Of course, we need to be aware of maintenance costs. So by transferring the cottage into a trust, the grandparents could also fund some additional funds as a side fund in order to provide future maintenance costs, so that perhaps family members that do not have the financial resources to replace the roof or fix the dock have the ability to draw on some additional funds in the trust to do so. Life insurance solutions are often used when we look at cottage planning. And the main reason for that is, first of all, funding the tax liability on any transfer. So let's use an alternate example. Let's say Grandma and Grandpa have decided to maintain ownership of the cottage and allow their wills to dictate what's going to happen to the cottage after that time. When the second grandparent dies, so usually when the first spouse dies, the asset will pass to the second spouse on a tax-free rollover basis. But when the second spouse passes away, that's when the tax liability will hit. Ultimately, having life insurance as an estate planning solution, there can be additional funds flown into the estate to help pay for that additional tax liability on the deemed disposition of the cottage.
So in simple terms, I guess it's safe to summarize that the tax liability doesn't disappear, you're just passing that on to the insurance company at this point.
Basically, yes. We're looking for an additional source of funding to pay for that large cash outflow from the estate at one time. Now, estate equalization is an interesting topic, and this flows very nicely into our next discussion, which is about family harmony. So I'm going to draw you a picture of a family with 3 children. The parents are getting elderly. They use the cottage still, but they're really not in a position to maintain it anymore. They have 3 sons. One son lives in Vancouver and very rarely visits the cottage, maybe once a year. One son lives in Toronto and visits the cottage almost every weekend. He's the one that rebuilt the dock. He's the one that bought the new motor for the boat. He's the one that helps mom and dad the most with maintaining it, and he also uses the cottage the most. And we have a 3rd son who lives in Montreal. That son really has no interest in the cottage, never really liked it, frankly, and is far too busy with his own family and lifestyle to take part in it. When the parents are looking at their estate planning and writing their will, they need to think very clearly about who is the best person to give the cottage to. Should it really be split equally amongst the 3 boys, which is our typical reaction, or would it be better to make sure that the son that lives in Toronto that has put the most energy into the cottage and loves the cottage the most, perhaps he should actually receive the cottage as his inheritance from the estate? While that might make sense for the son in Toronto, it's not quite fair to the other 2 sons. And we all want to make sure that we're treating our heirs on some kind of an equal basis. We want to be fair. One way to avoid this problem, if you gave the cottage to all 3 sons, chances are they would have to sell the cottage in order to have an equal share of the value of that cottage. Selling the cottage probably isn't an issue, and perhaps the son in Toronto doesn't have the finances to buy out his brother's shares of that cottage, to own it himself. Well, with a little bit of forethought, the parents could purchase life insurance. By purchasing life insurance with a death benefit that pays out on the second spouse to die, we call that a joint last to die policy, then there will be enough money in the estate to pay off the brother in Vancouver, to pay an equal amount to the brother in Montreal, and to give the actual cottage to the son here in Toronto. This is one way to equalize how each heir receives their assets. Some sons are receiving cash as their inheritance, and the other son in Toronto is receiving an actual real estate asset. Another thing that life insurance can do, especially with a testamentary trust structure through your will, is the life insurance could be added to the trust so that it creates a fund, creates that maintenance fund for the future maintenance and improvement of the property. So I would suggest permanent life insurance if you're considering this. It's a very tax-efficient way to fund these costs, shown on the screen now. And policies can be designed either to grow in order to keep pace with inflation, or they can just stay at a flat amount level for life.
And without getting into details on insurance policies, a joint last to die is generally more cost efficient than an individual policy.
Generally,
right.
yes,
Yeah.
depending on the people that are applying at that time. Yep.
Okay.
So let's talk about reducing family conflict. Now, again, remember that we've got the family in my example has 3 sons. And if you've ever seen a family with 3 sons, you know they don't always get along. Typically, we see when we're doing some estate planning, the grandparents or the parents may often fill a role as peacekeeper in the family. They're the ones that translate between the 2 brothers who probably don't talk to each other as often as they should and perhaps misinterpret things. There can be perceived ill will from years ago when someone's baseball bat got broken. Who knows? But the reality is that when the parents are no longer here, there is no longer that peacekeeper role, and very often emotions can flare completely out of control. Imagine that your children are going to be emotionally overwrought when you're no longer here and dealing with your estate. So provide them with the guidance that they need. Think about it in advance and make sure that you've consulted them in advance so they know what to expect. In my example of the 3 brothers, the brother in Vancouver may actually be upset that he didn't have the option to receive the cottage as his inheritance. But if you explain to him why you set up your estate the way you have, he will be better, he will understand it better, and will be less concerned and emotional at the time of the distribution of the estate. You should also ask the right questions and spend the time to listen to the answers. You may think that everyone in your family wants to inherit the cottage, but you may be wrong. There may be certain members of your family that really don't have an interest in maintaining that cottage and would prefer to see it sold and the fair market value distributed equally. But ask them those questions, and then you can create a solution that's going to work for your family. And of course, when you're doing your estate planning, please always keep in mind that you want to maintain control of sufficient financial resources to look after you in your lifestyle and comfort for the rest of your lifetime. That's always the first consideration. But agreements that are put together prior to your death can speak to things like who should have access to the cottage at certain times. Will all the beneficiaries of the cottage contribute equally to the financial needs of the cottage and the maintenance going forward? Who makes the decision? If there's only 2 siblings in the family and they have a deadlock, they can't agree, then how do they break that tie? And of course, is there an option to sell the property at some point in the future? So if there is one child who isn't financially resourceful and is having difficulty putting food on the table for his family, don't force him to be stuck with an asset that he really can't make use of and really needs other assets. Give him an option to buy out at some point.
I think the important part here, as we always encourage clients, is really, planning ahead increases the efficiency of the tax efficiencies and everything else. And as Maureen mentioned, while you're here, you can discuss it with your family members. When parents are not around anymore, there's a lot of assumptions that are made that might not necessarily be what the parents have wanted.
That's right. So it's very important to communicate your wishes. A lot of us believe that when we're no longer here, they'll just figure it out. They're all adults. Our kids will sort it out. And the reality is they can't read your mind. So make sure that you communicated with them either in writing or verbally so that they know what your wishes are, and then they're better able to work on those and also better able to understand the solutions that you put in place in advance because of doing some advanced planning. So what are next steps? If you own a cottage and this sounds like a situation that you need to look into further, identify what your goals are. We have a tool called a Cottage Succession Planning Worksheet, which is available from our library, and it's a document to help you think through some of these questions and answers because there's a lot of soft issues you need to really think through. Then formulate your plan. Once you've identified what you want to see happen with the cottage, then come and talk to your legal and tax professionals as well as the Ortencio team so that we can help create those solutions for you. And of course, have a family meeting and communicate what plan you've put in place so that everyone understands what your wishes were in advance.
Great. Well, I want to thank you, Maureen, for taking the time for today's presentation. I hope everyone enjoyed it and got some value from today's webinar. As I mentioned in the beginning, and as Maureen mentioned throughout the presentation, each circumstance is unique, and based on the situation, one can utilize different strategies we presented today. If you'd like to get more details, or if you want to receive the worksheet, such as the Cottage succession planning worksheet, give us a call or drop us an email, and we'd be more than happy to send you that information, and we can talk individually, one-on-one, on your own unique situation. Thanks again, everyone, and we look forward to seeing you or hearing from us in our next presentation.